Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, we're going to be analyzing Booking Holdings stock, ticker BKNG. This one came in by request down in the comments of one of my other videos. If you have a request, put it down in the comments. I will get it on the ticker on the chalkboard behind me, and eventually I'll make a video. I just marked off one whole column today, and I went through and responded to everybody's comments to let them know that I got their tickers up there from the past 3 or 4 days. Usually go through about once a week and check those and get them on my list. I'll either post your video here on YouTube or on the free Patreon tier. So check that out down in the description as well. And I have weekly picks on Patreon for $25 a month. Those have been going really well, outperforming the S&P 500 by quite a bit. Everybody's really happy with those. And then I have a full service there where you can see all the spreadsheets that I have, especially the main one that I use for valuation purposes. And you can see what's a current buy, and it updates pretty much in real time. Okay, as always, it's not individual investing advice, just how I analyze stocks. I did cover this one about a year ago along with Expedia. But since it had been a year, I thought I'd revisit for everybody here. I'm going to use the time until payback method for this one. So this looks and estimates how long it would take the business to pay you back an equal amount from their earnings that you paid for the business. So if you bought the whole business for $100, about how long could you expect it to take to earn $100 in earnings? Of course, that can be scaled up for however much you end up buying, but that's the process for kind of evaluating the stock. So in order to do that, we basically need two things. We need an earnings yield, which is the inverse of the PE ratio. So it means the same thing as the PE ratio, but it's expressed as a percentage. So like a 20 PE ratio, if you inverted it, would be 20 over 100, I think, and that would be about 5%. So a 5% earnings yield is the same as a 20 PE. I'm doing that in my head really quick, so I think it's right. And then you also need an earnings growth rate. So you have to kind of decide what earnings growth rate you want to use. What I do is I look back at, I call this the full cycle analysis when I do it, when I express it a little bit differently. Because when I first started doing it, I always wanted to make sure I had a recession in there. So it was a full business cycle. Well, COVID was really weird, and the last recession before that was like 15 years ago or more than that now. So maybe I should change the name. I don't know, because I can't really go back that far for a lot of stocks, or they've changed a lot since then. But ideally, you don't want to take a short period of time. You want to take a pretty long period of time. So I used about a 10-year looking back time frame, and I see, well, how fast did they grow earnings during that time? And then I'll use that for my estimate to estimate in the future, unless there's obvious things that happened, like they did in this case, right? So if we look at the fast graph here first, this dark green shaded area kind of represents their earnings per share. They had really good earnings growth for the first, call it 15 years or so of this chart. And then we have this big drop. So now normally when I look and I see a drop like this in recovery, I would say, oh, well, that's the cyclical business. This might be a cyclical business, but we know that this was because of COVID. So, which is hopefully a one-time thing, at least one time a century. I don't know, it might be more than that, but I'm not going to model that in for the next 10 years, put it that way. So next 10 or 15 years, I guess. So for when I estimated my earnings growth rate, I excluded these COVID years. I had a note in my spreadsheet that told myself that that's what I was doing when I calculated it last. So I'm just going to pretend like basically this downturn in recovery didn't really happen. The other big factor is these guys have bought back a lot of their shares. They bought back 36% of the business, so more than 1/3 in the past 10 years. So they're using their earnings that they have from their business, and they're taking it and buying the stock of the business. I have kind of neutral feelings on that, generally speaking. if the price is low, if the valuation is low, then it can be good that they're buying back their stock. If it's not, then if it's high, then that's bad. And if it's in the middle, which I would say this has usually been in the middle, then it's just kind of okay. But you want to make sure you take that into account if you're doing your earnings growth rate based on earnings per share, which is what I'm doing. So earnings, when shares are reduced, the earnings per share growth looks higher over time if they're reduced over time. So I try to adjust for those, because my thinking behind this valuation method is you own the business, and I want to know how much you would earn regardless of what you do with the money. So if you take it and you buy back shares, or you take it and you pay a dividend, well, that's on top. That would be double counting if I allowed that to influence the earnings growth rate. I kind of want to know what the organic owner's earnings growth rate would be. And you never know the exact price the company's paying for all the shares. So I just estimate it. I have a little method that I use to estimate the adjustment for buying back a third of the company, right, over this time period. And so when we look at the FAST graph here, we see a 14% earnings growth rate. It might be a little, we'll see what it is let's see. 2014 was a very big year. So let's say we do that and that. So 13%. Mine's going to be more like 8.5, almost 9, I think. So I'm using a more conservative earnings growth rate going forward because of those share buybacks. Let's see where we're at here. So, and that's less than what the market is expecting here, if we just look at that. I'm not really going to make an adjustment for debt because it looks like there's not very much difference between the market cap and the total enterprise value. S&P credit ratings, excellent. So that all looks really good. It's really just a question of how fast can they grow their kind of organic earnings growth. The market's thinking mid-teens. So what's the PE? 26. So if you look at what the market's predicting and you look at the valuation, it looks pretty cheap. It doesn't look super cheap, but it looks, compared to the S&P 500, it looks pretty reasonable. There aren't too many businesses even growing that fast that aren't very small. So since I'm using a lower earnings growth rate, though, we'll see how that turns out. Okay. So I'm assuming the earnings grow at 8.73% per year. The earnings yield is just under 4% here. So the way I like to think about that is if I bought the business for $100, it would earn $3.95 for every $100. I pull forward the first year's earnings growth, so my first year will actually be a little bit more than that. And that's how the thinking behind how I set this spreadsheet up. So the first year we earned $4.30 on a $100 investment, or purchase price, or however you want to think about it. The next year, and you get to keep that, and then the next year you earn $4.67, and the next year you earn $5.08. And the question is, how long would it take that to build up to $100? Time until payback. How long does it take for you to earn an amount equal to your investment back? So using these calculations, it would take about 14 years to earn your money back as like the owner of a business. So let's just put 15% in here for earnings growth. So if you believe the analysts, they think 15% earnings growth the next couple of years. That would be an 11-year time until payback, much closer to a buy, which under 10 is kind of really what I'm looking for. Maybe 9 to 10, basically. So if you believe what the market's forecasting, then it would be pretty close to a buy, and definitely much cheaper relative to the market, which is what I was talking about earlier. But I question whether the market really believes that, because otherwise because right now it's valued about the same as the S&P 500 using my earnings growth assumption that's closer to 9%. Because 14 years is right about where the 14, maybe 15, right about where the S&P 500 on average is. And so the lower, the better. Like the faster you can earn your money back, obviously, the better. But so I would say this is a little on the expensive side here, but not any more expensive than the wider market. If I owned it, I'd probably hold it. especially since maybe they will grow earnings in the mid-teens the next couple of years. I mean, who knows? If they do that, then the market might become more convinced of those forward numbers, and it could, hold in pretty well. So I would call this one kind of a hold right now, even though it's on the expensive side. That's if I already owned it. In order to buy it, if I remember correctly, like 3,200 was about the, maybe 31. Try 3,000. I'll give like a little range here. Yeah, so in between 3,000 and 3,200 is about where I'm at on my buy prices, even using my other method that I use. That's kind of right where they're at. I have two other ways that I look at this. One's a recession PE. That one's about 3,100. The full cycle analysis, which uses like a estimated 10-year CAGR. That one's at about 3,200 for the buy price. So and this one's at like 30, in between 3,000 and 31. So like that's kind of the area everything's pointing to be undervalued with a margin of safety, using this kind of a long-term growth rate, and also based on kind of what it's done in the past during downturns. So that's probably what I would aim for. And it looks like it's maybe 40% lower than where it is now. Now that's not fair value. That's below fair. That's like with a margin of safety. So that's my thoughts on bookings. I do track this one. I've had a buy price on it for a while. I probably would buy it if it got down to those levels, even if things looked kind of scary. Maybe there was a recession or something. I mean, that's probably what's going to have to happen in order to, I suppose if there was global calamity, enough of it that disrupted travel, you could see that potentially do it too. So you would have to ignore whatever the short-term or medium-term problems are. That would probably be the type of thing that would send the stock price down low to get you a chance to buy it. But that kind of 3,000 to 3,200 area is where I'd be looking to buy. Okay. If you have found this useful, hit the like and subscribe button. You have a request, let me know. And I'll see everybody later.